a financial advisor's 1% fee, or a 0.03% index fund. Pick wrong, and over your investing life, it is not 1% of your money that quietly disappears. It is closer to 30% of every dollar you ever earn. On a $100,000 start with $1,000 a month for 40 years, that one choice is the difference between $5.86 million and $4.26 million. Same investment, same 8% return, same you. The gap is roughly $1.6 million, and almost none of it is going where you think it is. Look closely at the deal you are actually agreeing to when you hand your portfolio to an advisor who charges 1% a year. You are not giving up 1%. You are agreeing to a fee that grows every year your money grows, skimmed off the top before compounding can do its work. The quote is a percentage. The bill is dollars, and the dollars get bigger as you get richer. The entire question turns on one variable, and only one. Does that advisor hand you back more than the fee takes out? Not once. Every year for decades. Because the moment the fee leaves your account, it stops compounding for you and starts compounding against you. Most people never notice because it is never a check you write. It is just a slightly smaller number forever. Watch the compound growth curve. Two investors, identical in every way. Both start with $100,000. Both add $1,000 every month. Both earn 8% gross year after year for 40 years. The only difference is the fee. Investor A holds an S&P 500 index fund charging 0.03%, so she nets 7.97%. Investor B pays an advisor 1% on top of the same fund, so he nets 7%. For the first few years, the two lines are almost touching, a rounding error you would never feel. By year 10, they have drifted apart by low six figures. By year 25, the gap is a canyon. At year 40, Investor A lands at $5.86 million. Investor B lands at $4.26 million. 1 percentage point of fee, and $1.6 million simply never shows up. Now put that $1.6 million shortfall on a money flow waterfall because the size of it breaks people's intuition. A 1% fee feels like you are giving up 1/8 of an 8% return. Annoying, survivable. But run the full 40 years, and that fee has swallowed 27% of the final balance and 30% of the lifetime gains. Not 1%, nearly a third of everything the money earned. The reason is simple and brutal. The dollar taken in year one does not just cost you $1. It costs you 40 years of compounding on that dollar. Every fee payment is a seed you were never allowed to plant. Multiply that across 4 decades of payments, and the leak is not a haircut. It is a third of the harvest, gone before you ever see it. Flip the percentage into an invoice on a stat callout, and it gets a lot more visceral. 1% on a $200,000 portfolio is $2,000 a year. Fine. But the fee scales with your balance, so at $2 million, it is $20,000 a year, more than many people pay in rent, often for advice that did not change one bit between the two. And this is the part that stings. In a flat market year, or a down year when your account is bleeding, that fee still comes out. It is charged on total assets, not on your gains. You pay it while you are losing money, and the advisor's dollar pay actually rises in every year the market rises, whether or not they made a single decision. So what would it take for the advisor to be worth it? We can compute the exact break-even. The fee spread is 1% minus 0.03%, which is 0.97% a year. To merely hand you back what the fee removed, the advisor has to add about 1 full percentage point of extra net return every single year for 40 straight years, never missing once. Not beat the market someday, beat it by a point annually for 4 decades. Now line that up against reality with a side-by-side rate comparison. S&P's SPI scorecard tracks how professional active funds actually do. Over 15 years, 89.5% of large-cap active funds underperform the S&P 500. Over 20 years, roughly 92% underperform. And it gets less forgiving the longer you wait, not more. So if the advisor's pitch is, we will beat the market to cover our fee. The data says that is a coin that lands wrong about 9 times out of 10. There is an honest counter-argument here, and skipping it would be dishonest. The math destroys the stock-picking advisor. It does not destroy the coaching advisor. Look at the bar chart of how real investors behave versus the index they are actually invested in. DALBAR's research finds the average equity investor trailed the S&P 500 by about 1.1 percentage points a year over 20 years, and in panic, years that gap blows out far wider, north of 8 points. People buy high, sell low, and bail at the bottom. That behavior gap is real money, bleeding out year after year. Vanguard argues a good advisor can add around 3% a year of net value, most of it not from picking stocks, but from behavioral coaching, tax-smart account placement, and disciplined rebalancing. Vanguard sells advisor services, so treat that 3% as an optimistic ceiling, not a promise. But the direction is right. An advisor who simply stops you from panic selling in the next crash can clear that 1-point break even through discipline alone. The villain was never the advisor. It is a bad advisor, or your own hands in a downturn. So here is how to actually decide at any portfolio size. First, convert the percentage to a dollar invoice. Take your balance, multiply by 1%, and ask whether you would write that exact check every year for the service you get. If the answer is no, you have your answer. Second, run the break-even test. Your advisor has to add roughly 1 net percentage point a year to justify the fee. Ask them plainly, through what? If the pitch is, we beat the market. SPI says, treat the fee as a tax on 30% of your gains with about 10% odds of paying off. If the pitch is, we keep you invested and optimize your taxes, judge it against that 1.1 point behavior gap it has to close. And that is a fairer fight. Third, match the structure to yourself. If you are disciplined, buy and hold, and comfortable with a simple 3-fund portfolio, the 1% is a pure leak. Go DIY index funds at 0.03 to 0.11%. If you know you would panic sell or chase performance, an advisor may genuinely recover more than the fee, but favor a flat fee, hourly, or advice-only planner over the 1% model. That one swap kills the worst part of the deal, an advisor collecting an automatic raise every year the market climbs. And this matters just as much at $30,000 as at $2 million. On a $500 a month habit over 30 years, the same 1% still quietly eats about $400,000. Younger and smaller does not mean immune. It means you have the most compounding left to protect. So the answer to the silent leak is this. A 1% fee is not 1% of your money. It is roughly a third of your lifetime gains, and it is only worth paying if the advisor closes a behavior gap you truly could not close on your own. If that is you, pay gladly and sleep well. If it is not, that 0.97% belongs in your account, compounding for you instead of against you. If this changed how you see that number on your statement, subscribe. The math on the next big money decision is already queued up. Your one move this week, pull up your latest statement, find your all-in fee, and multiply your balance by it. Look at that dollar figure. Then decide whether it is buying you a point of real discipline or just quietly leaving